Switching to some long bot options discussion, a mix of questions for David. Okay, situation question number 1. It says, Mike, I purchased the following. Netflix, September 2nd, 260 call for 651 on 8/15. It is 2 weeks before it expires, and I wanted to know what kind of hedges I could potentially do with this option. And he says, I understand that suggestions do not constitute investment advice, and I accept full responsibility. And then he goes on and says, situation number 2, I bought an AMD 26-100 call at 0.0866. I think he meant 86 cents. I'm going to assume he meant 86 cents looking at the price, but I'm going to go with 86 cents. If I'm wrong, David, you can point that out to me later on. He says, I wanted to ask a couple of things. First, when an option expires in less than 1 week, how would someone look to hedge against that option if it goes into the money? Second, I know the probability of profit is only an indicator at the time of purchase or sale. However, I wanted to ask what I look at primarily from the Greeks that would give me an indicator as how the option may go. You buy a call, what direction should you look for the delta and other Greeks to be trending, and vice versa for puts bought or either puts and calls sold. Third, when a stock is trending up and you buy a call, what is the advantages and disadvantages of selling the put? Both are bullish, and can one be used potentially to offset the other, and what would the setup be? That's the easiest question to answer, but we're going to go in order. So I'm going to revert back here to situation number 1. We're going to go back to power options to look at these positions. Okay, and we still have plenty of time, so I'm going to encourage anyone that if you have any questions, don't think I'm going to spend a half hour on all of David's comments there. We're going to spend as much time as needed to be thorough, but we're not going to spend the full half hour. So if anyone has questions, please feel free to send those in as well. All right, situation question number 1, Netflix, 2nd of September, 260 call for 651. It is now 2 weeks before it expires. What kind of hedges could I potentially do with this option? Where is this option now? It's not in my radioactive portfolio. It's in the August 19th portfolio, which is why I can't find it. All right, August 15th, 260 September 2nd call. Netflix purchased at 615. It's down 415, 67%. So it's trading at 201. A 67% loss on the position. Let's take a look at the profit and loss chart. Now it's down 67%, but let's keep in mind monetary. We're down $4 on this position. First thing I have to say on this, and most of you know what I'm going to say, is that we saw that we're down 67%. Typically for me, like a credit spread, debit spread, any leverage position, I'm usually looking to close or adjust, but in most cases, I'm looking to close a long call if I'm near that 40 to 50% loss target. I don't want to let it go to 70, 80%. Unfortunately, we don't know, David, what's going to happen on Monday. Netflix opens down another $3 or $4. This might only go to 30 cents. It's a possibility, even with 2 weeks to go. So then you're going to be looking closer to a 70 or 80% loss, which means it's going to be really difficult to manage at that point, unfortunately. You've got a deep out of the money call here with 2 weeks to expiration. Another rule of thumb, I don't like buying calls that are 1 or 2 weeks out in time. I want to give myself more time for the stock to move in my direction. And really, I want to take advantage of the time value decay curve. You're at the very bottom of this in that case. And that's, of course, when we look at it here, the biggest decay happens in the last 30 days. Here's 20 days. That's a little skewed. And here's 10 days. So you're on the rapid end of the time value decay curve here if it doesn't start going in the money. So choices are not fantastic. There's ways to manage a long call. I'm going to point you to the playlist. I know I'm getting redundant with that, but that's where a lot of great information is. You could convert this to a static bear call credit spread. You paid 6 for 15 for this position. The stock's at 241. If you think we're going to stay down in price, can I get the money I need? No. The 240, 250's old. Oh, sorry, was it 610? 615. Okay. So at this point, you could sell the September 245 call. We just converted it to a bear call credit spread with a very small profit potential. I'm not saying this is the best one, but here at the 245 strike and at the 242.5 strike for the same expiration are the only ones that have a premium above what you paid. So the only ones that would have any profit if the stock stays below that strike. You couldn't create a bear call right now with a 250 or 252. Wouldn't give you enough credit. You'd be a guaranteed loss. Less than the maximum loss you could take on the 260 if it expires worthless by selling that premium. You see the risk. I'm sorry, stay here. You see the risk, obviously. You're doing a bear call. What happens if next week we're the opposite of the last 3 days of this week and it's back up to 254? Now you're at $1,000 loss instead of the 615 you could max lose on the long call position to begin with. Earlier, we showed the idea of repairing a bull call debit spread by converting it to a debit condor or debit butterfly. This is also commonly used here in some scenarios when a position is moving against you on a long call. I could do a ratio call spread by selling 2 September 245 calls and 635. I want to go 235. I can't go to 232 because that's not really too expensive, is it? Considering, yeah, I know it's going to be a debit. Oh, no, I can't do a debit. I'm sorry. I bought a call. I didn't sell a call. I bought a call, so I have to have this less. So I'm probably using the 237.50. I don't know if this is going to work out. So you're doing a ratio call spread here. You're buying 1 237.50 calls, selling 2 245 calls, leaving the 260 open. So this gives you a potential profit here in an upper break even of a lower break even of 241 and an upper break even of 248. It's still pretty tight. It's only a $7 window for 14 days. But as you can see, it does get you in a profitable position. Again, you've doubled the loss to this side if the stock moves up against the maximum risk is 1,100 instead of 615. So if Netflix recovers, you've got a bull call debit spread here that's going well, but you've got a wider bear call credit spread that's killing you. And I forgot to mention, of course, doing the bear call, you'd have to cover the margin between the two strike prices. But converting it to a butterfly, converting it to a condor is one approach. Not necessarily to hedge, but if your expectation was Netflix was recover, we could just bite the bullet and roll down, still leave ourselves 14 days. You could go further out in time, get whatever you can back for this and say roll down to the 250 strike. Why is this any use? Remember, your original break even for the position that you were in was 266.15 at expiration. This lowers the break even down to 258.64. You do have a cost basis now of $864. It's $200 more than you initially started, and you can still lose that if it stays below 250. You're increasing the risk. Essentially, rolling down what we're doing here, David, this is one of the ways, essentially, that it's like averaging down a long stock position. You're averaging down your call strike and the call cost basis. You're increasing the cost basis as you would be putting more money into averaging down a stock to get a better break even if you think the stock's going to recover. You could roll further too to the 240 or to the 230, but remember that price is going to be higher, so the total cost and the total potential loss is going to be higher as well. I mentioned that because you asked for a hedge. This is a way that you might be able to get back to break even, but it's not hedging it. It's adding cost to sort of average down, and price might not be what you want. And I mentioned the bear call spread. Now that the stock is down, you could do the same thing in a calendar function, but you only have 2 weeks. So there's no guarantee you could get to profitable. What I mean by that is we could sell something, say the 250 call for next week and get 224. This is going to create a reverse calendar call spread where your long call is out of the money, higher strike price. It doesn't get you back to profit, but what you did is lower the cost basis by 230 to 385, and then you're going to try to look for an opportunity to sell another call for the next cycle after 26 August expiration. This doesn't look attractive, but it lowers your risk from 615 down to 385. You don't want the stock to go above 250, so you'd have to roll that or manage that if it does. But again, the long call will be working for you, but buying this back may cost more, so you're going to add to the cost basis of that really short-term long call in that case as well. So some of the ideas of hedges, once again, I'm going to go back to YouTube, and you saw some of these. It was in the long call discussion that I just lost. View full playlist. Managing a long call that is near full loss, you're not there, but check out ideas for managing a losing long bought call. You'll see other examples of what we just discussed there as far as hedging, converting it to a credit spread, converting it to a butterfly, lowering it. Now, keep in mind, you could also roll down, as I mentioned, say from the 260 to the 240 or the 260 to the 250, and then try to convert it to a butterfly or a credit spread, bear call credit spread. But you'd have to have the anticipation and the expectation the stock would continue down in price. That's what I want you to check out. Ideas for managing a losing long bought call first. And if you have time, you can look at managing a bought call that is near full loss as well. You're not quite near full loss, but it's getting closer, and that's the risk. Monday's going to be a tricky one to see what happens with that Netflix position and all other positions as well. Okay, let's go back to the portfolio, August 19th. Let me go to your second question. You bought the AMD 100 call for 1 week out. I'm assuming you meant 86 cents. You said 0.0866. I think you meant 86 cents. I'm not positive. An option expires in less than 1 week. How would someone look to hedge that option if it goes in the money? Similar things to what we discussed, but kind of reversed. If this stock continues to move up in price, it goes to 105, 106, 107. Then, as we discussed before, you only got a few days to expiration, so it's going to be very, very tight, but you might be able to sell, now that the stock's up in this range, you might be able to sell a 105 call for 50 cents, 80 cents, or 90 cents to create a bull call debit spread. And this isn't real, but I'm going to say if the stock's trading up at 104 on Tuesday, we might be able to get 85 or 83 cents, even 80 cents for this call. And that will give us a pretty good looking bull call debit spread position. Not a lot of risk, and if it stays above 105, you have the potential to make $499 off essentially no cost basis. That's a good hedge to use. You only have a small amount of days to do it, though, so it's tricky. If it doesn't happen until Thursday, you're not getting 80 cents for this. You're probably only getting 20 or 30. Could it still work if the stock's above 105? Absolutely, with a cost basis of 60 cents or 40 cents or so. But again, that's one way to do it. You could do the butterfly. Stock goes up to 103, you could sell 2 105s and maybe buy a 115. That might still give you a good profit range that you could consider as well. I don't want to time the trade this way, David, but if you're worried about if the stock moves up to 112 or 115, and you've got the profit on the long call, with only 2 days to expiration, I'd say take the profit when you've got it. Don't try to lock in a gain with only 7 days to go. If you think the stock's going to continue up, you like AMD, your option is, of course, to close that and take the profit and roll it out. Buy another 3 week out, 2 week out, 4 week out call on AMD at the 105 strike or the 110 strike. But remember, if the cost of that is higher than the profit you took on this one, if it expires worthless, you didn't win on the trade. You lost all around. So that's something to consider there based on that also. Okay, so I wouldn't say this. If you had time, so let's say next week by Wednesday, the stock's up at 105, but you think AMD is going to fall again on Thursday and Friday. Is it a good idea to buy a 100 put to hedge this call? I think it's too close. I'd rather just take the profit on the long call and just move on. Look for another, maybe then buy a put for 2 weeks out if I think AMD is going to fall. But I'm not going to say buy a put against this call to create a strangle position or a straddle position. Too close. You're way too close. Only 1 or 2 days to expiration. That's really trying to time the market. And I think it would take a winning trade into a losing trade if you didn't see the significant movement you needed to profit on the put based on the cost basis that would cost you without taking the profit off of that long call or some of those long calls. But you did mention you bought one AMD, so you don't have the opportunity to sell half right now and try to manage it that way. All right, so let's take a look. I'm sorry, I didn't mean to get out of the portfolio. I meant to get out of the profit and loss chart, not the portfolio. AMD. I'm going to go to research, which shows everything. Anyone has any other thoughts on what I'm about to say, please share them with me. Okay. David's second question was, he says, I know the probability of profit is only an indicator at the time of purchase or sale. I want you to keep something in mind. If you're looking at your broker, I don't know if you're using TD Ameritrade, if you're using Thinkorswim, if you're using Tastyworks, or if you're using Interactive Brokers, if they show a probability of profit equation for you based on implied volatility, the past volatility of movement of the stock, and how far out of the money the call was at the time of purchase, that's one thing. What I don't want you to mistake is that if I bought this 100 strike call on AMD right now, and it's still at about the same, it's at 90 cents. Okay, so my cost basis is 190. It's still pretty close. Okay. The 25% probability above I'm seeing here is not the probability of profit for a bought call or a bought put. It is for an out of the money bear call. The probability that the stock would be above 100, that's a good reasonable probability to look for. I want a 75% probability below for a bear call if I'm selling the call. If I'm in AMD long term and I'm selling a 1 week out call, 75, 80% probability below or a 25% probability above, I don't want to get assigned. I want it to expire worthless. That's in my favor. This means there's a 25.3% probability that AMD will be above 100 in the next 7 days. You don't need that. You need to know the probability that the stock will be above 190, the strike price plus your cost basis into the call option in order to profit. So it's going to be lower. Maybe not much. It's only 90 cents, but it might be as low as 21 or 18%. That there's an 18% chance the stock might be above 100.90. Let's just call it 101 in the next 5 or 6 days. That's your profit, not above 100. The probability above and probability below is just looking at the static strike price of our 100. So using power options, we just show the probability above and below. If you're looking at a different probability of profit, that's one thing. The main question here is you want to say, I wanted to ask what I would look for primarily from the Greeks that would give me an indicator as how the option may go. And if I buy a call, what direction should you look for the delta and other Greeks to be trending? Well, the only thing I can say on that is that if you're buying a call, you'd want to be considering seeing a delta that has been moving up because that implies the stock has been moving up and the delta is increasing. The gamma should be going up in that case as well. This is not an indication. These numbers here, these static numbers, delta, gamma, theta, vega, rho, are not indications of any market direction whatsoever. They're giving you indications of how the options should move based on a 1-point movement in the stock price. They're giving you indications of how the gamma will react, which will affect delta, how your theta is going to decay on your long option, which you want to pay attention to, but it's not giving you any directional value. It's not saying at all, what is your direction going to be? Someone who trades a calendar spread, will they look at volatility skew? Yes, comparing the volatility of a near-term option to a far-term option to decide if that's a volatility smile or a volatility skew. Does that give them an impression that's going to be a bullish to bearish move over the next 3 months for their calendar spread, not in the next 10 days, but more in the next 3 months or 4 months? Some investors use that. Will an investor maybe use an at-the-money delta ratio, looking at the delta of the near-term at-the-money option to the 2-week out option to the 4-week out to the 5-week out, and try to grab some kind of ratio equation that tells them that, oh yes, the 3-month out is only 2 times the current, or 2 times less than the current delta than the 1 month out is, which gives to me an implication that there's more expectation of movement in the next month than in the next 3 months. I don't know. I've seen some equations like that, but I don't even know what they're trying to point to, unless they're trying to point to a better calendar spread. Implied volatility range, percent implied volatility range. This may tell you that the option is expected to maybe bounce back from the low of its percent implied volatility range to the high. That could mean that the stock is going down, or that could mean we just headed out of an earnings and it was at its peak, and so now this is the normal range of implied volatility. You have to do the further research on the underlying security to see that. Will investors sometimes use the put-call volume ratio, put-call open interest ratio in these equations to determine if a stock is overvalued or undervalued, or I'm sorry, overbought or oversold is a better term to use? Yes. Why aren't you seeing it here? Because it's considered more of a stock criteria than an option criteria in those cases. So that, the put-call volume ratio of 0.8 tells us there's currently more calls right now than puts as far as volume, and the OI ratio is a little higher. It's almost equal to 1. So it's almost the same value, 1,528,000 puts to 1,557,000 calls. Some people use this as a direct indicator. Some people use it as a contrarian indicator in those cases. Delta is used more to determine, like you said, the probability. If I'm in a spread position, a credit spread, an out-of-the-money credit spread, I'm selecting a delta of maybe 0.2 or maybe 0.15, which equates essentially to an 85 or 80% probably the stock's going to be trading above that. The delta when buying a call or buying a put is just telling you what to expect with a 1-point movement up or down in the stock. It is not giving you a direction by itself. And looking at the static view of the Greeks, my gamma, my theta, my vega, by themselves on a single option is not giving you any indication of really what the stock is doing. You have to look at further insight as to, if I did a spread more or less, what is my gamma hedge? Am I gamma hedging? Am I delta hedging? Am I vega hedging? I've never even gotten into that aspect of things in those cases. You want to make sure that your stock is going the direction you want. And here's the other thing. You hear a lot of investors out there say that, oh, when you buy a call, you should always have a delta of 0.7 or 0.8, and you should always have a gamma of XY. You should always be in a percent IV rank or percent implied volatility range of less than 40, so you're not overpaying for the option. And you want your IV to HV ratio to be less than 1, your Black-Scholes ratio to be less than 1, so you're buying into an undervalued option. You find the perfect structure of all of those things you're looking for, but you buy it on a stock that's been moving down for 3 months and is showing no signs of stopping, you are not profiting on a long call. If the stock doesn't go in the direction that you need for the sentiment of the trade, it doesn't matter what your delta is, your gamma is, or your theta is, or your vega is. The stock doesn't go up when you buy a call, or if a stock doesn't go down if you buy a put, you're not going to be profitable. Doesn't matter what the Greeks are at that point. It needs to match the direction, and that's why we tend to focus on the trend lines of Bollinger Bands, MACD, and more in our searches on power options with Ernie's Bollinger Band breakout searches for long calls and long puts as the default searches with other technical criteria for the stock itself, with looking for what we feel is a reasonable delta to use in those structures. Last but not least, and like I said, if anyone disagrees with me on my statements, if anyone feels that you can look at a static option chain or research tool that I'm looking here and just look at the static delta number as it is right now, the gamma number, the theta number, the vega number, and from just those static numbers at the current time, predict that the market's going up or down, let me know, because I've never heard of that or seen that before. That's not what it's doing. It's helping you for the strike selection, helping you realize what your decay is going to be, helping you realize how it's going to be changing as the stock moves. It's not telling you bullish or bearish. You need to do comparisons and look at the trends of the stock and maybe do, delta over different months comparisons with the same strike price. I don't even know what to look for with that because I've never used it myself. And I don't know if anyone ever does. I've just seen a table that had a comparison on it and they were trying to point to some concept and I didn't catch what it was. And I didn't even think it was accurate. Last but not least, I'm sorry, let's go back. Your good one was AMD. Well, yeah, the good one was AMD here. It's not the profit and loss chart. My apologies, folks. Go to the profit and loss chart on AMD. It's not too bad. It dropped $4 today, but you're still seeing a profit sort of on this position. It moved up at first. So let's just take the at-the-money position right now, the 95. David's final question. Third, when a stock is trending up and you buy a call, what is the advantages of disadvantages of selling the put? Both are bullish and one can be used to potentially offset the other, and what would the setup be? It doesn't offset the other. Selling a put and buying a call is a synthetic long stock position, David. That's all it is. So 95. Buy a 95 call for $390. You're going to hedge some of it by selling the 95 put for $291. This is actually, that's about right. I was going to say it was terrible, but it's about exactly right. We're buying the call. It's going to cost us $390. We're selling the put. I guess we're going to get about $280 for it. Same strike. What is my profit and loss chart? It's a long stock position. You've entered a synthetic long stock position, but here's the issue. The call, which gives you the right to buy shares of stock at 95, does not cover the obligation you have for selling the put, which obligates you to buy shares of stock at 95 if the stock's trading below it. This gives you the right, to buy shares of stock at 95 if the stock's trading above 95. If the stock's below 95, you have an obligation to buy 100 shares of stock at 95 and your call expires worthless. It doesn't help you. Did you only pay $103.50 debit to get in this position? Yes. But this is still a naked put. The call does not cover the obligation of selling that. You still have to put up, if you put up the full cash secured amount, $9,500 to cover the obligation of buying 100 shares of stock at 95. Why did I say this is bad? You have to pay a debit of $103.50 to do this. And if you're in a cash secured structure, you can't use margin for selling a put option. The call doesn't cover this. You have to put up the full $9,500. You've got essentially now $9,500 tied up in the position and a debit of $103 for a cost basis of $96.03 when I could have just bought 100 shares at $95.95. So when you buy a call, selling a put is not the opposite. Buying a put essentially is the opposite, to create a strangle or long straddle position. This structure here is a synthetic long stock. It doesn't offset it. It is a completely different obligation. You are now obligated to buy 100 shares of stock at 95 if the stock's trading below it. And in that case, the 95 call would expire worthless. And that's it. Are there other structures you can use? Well, of course. So let's say, for example, I buy the 85 call right now. I'm sorry, what's my expiration? September 2nd. This gets weird, though. So I buy an in-the-money 85 call for a right price of about $11.50. And I sell a 95 strike put at the money for $2.89. So this still gives me sort of that synthetic long stock position with an infinite max profit to the upside. I still got to put up $9,500 and I paid $858 for this position. But what's great, what happens here is if the stock's at my break even, if the stock, my break even is 94.29. I'm sorry, David. Let's say the stock goes up to 98. Now my 95 put expires worthless, and this would be worth $13. I only paid $858 to get into it, so our profit would be at $441, $496. You hedge some of the cost by selling the put, but it doesn't negate the obligation. You still have to put up the cash secured value, if you're not using margin, to cover the obligation of the put. Even an in-the-money call doesn't hedge that. Yes, you have the right to buy 100 shares of stock at 85 if the stock's trading at 80. But that would be long 200 shares. So here's what I mean by that. If the stock fell to 90 and you did nothing, this obligates you to buy 100 shares of stock at 95. The put buyer forces you to buy 100 shares of stock at 95. You don't do anything with this 85 call. Your broker assumes you want to exercise it. Now you've got 200 shares of stock because your long call was exercised at 85. The short put was exercised and you bought shares at 95. So you have 200 shares with a cost basis at 90 on a stock trading at 90. It's not bad, but did you want to own 200 shares? Was that your end game for the strategy? I don't think that's what you were looking to do. Okay, so that's what happens when you sell a put against a call, whether it's different strikes or whether it's the same strike. You can find yourself in sticky situations. The idea, investors who use this, is just for a synthetic long stock position. Most investors I talk to who are using this are able to do it in a margin account where they might only be putting up 50% or 40% or so, or 50 or 60% of the full monetary requirement. If I'm only on level 2 and I'm in a restricted account like an IRA, and I have to use the full monetary requirement, that structure I showed you didn't make sense. If I'm doing that, I'd be putting up 96.03 to synthetically own 100 shares of stock. Why not just buy it outright at 95.95? Okay. Sometimes you see discrepancies. That's what investors look for, where the time value of the at-the-money put they're selling is greater than the time value of the call, so you get a lower cost basis. That's when you look to use a synthetic long, of course. I don't want to pay more if I have to do the full cash secured amount on it in that case, when I could just buy it at market at cheaper. Those are my thoughts on your questions, David. I hope I got those correct. I do hope, I want to say that your AMD 100 calls were a cost basis of 0.0866 cents that you wrote to me, but I think you meant 86 cents in that case. So we're going with that. But yeah, you've got a good position. If it only costs you 9 cents to get in the position, it's currently at 90. You might just want to take that out.